Ladies and gentlemen, the next panel is about to begin. Please come on in and take your seats. Gentlemen, the stage is yours.
Thank you. Hi, good morning. For those of you outside who want to come in and join this panel, now's a good time to do it because we're just about ready to start. But while that happens, good morning. On behalf of the Millikan Institute and also CNBC, it's an honor and pleasure for me to be here with you folks. I'll introduce you to our panelists in just a bit, but let me just get some housekeeping out of the way. We're going to go for about 55 minutes with you folks. We're going to carve out probably 10 at the back to take questions from the floor, and that's going to be pretty easy. Just if I could ask just three things. If you have a question or a comment, raise your hand. 1, 2, tell us who you are and where you're from or who you represent. And 3, who the question or comment is for. That would help us. That would help us a lot. Okay. And I'm pretty sure that there are probably wireless mics that'll run up to you or something like that. But we'll work it out. And also need to let you know that these are not Chatham House rules that we're going to be talking under. It's open for reportage, so my colleagues are somewhere back there, and other media are in the room as well. So, and I'm told that this session is going to be uploaded onto the internet, so it's going to be free for all. So, if and when you do have questions or comments, just bear that in mind, and be forewarned. All right, let me quickly introduce you to our panel. We're supposed to be talking about the outlook for U.S. capital markets 2015. And this being the first Asia summit for Millikan Institute, we want to follow the script, but at the same time, John and I were talking a couple of minutes ago, and we thought that it might be useful at some stage to also somehow bring in and talk about Asia. So we'll try and be accommodative in that sense. But okay, I was talking about John. So John Sokoloff on my left is managing partner at LGP Leonard Green Partners. PE, VC, they've raised, as far as my research goes, $15 billion in PE money since inception in '89. Is that right, John?
Yeah.
And they have invested in 65 companies with an aggregate value of $60 billion. Of course, when you hear about either John or LGP, you think about Whole Foods, you think about J. Crew, but John was careful to stress, look, that's what we're known for, but that's not everything we're about. Next to him, Samir Jain is chief economist at American Realty Capital, based out of New York. Real estate, PE, alternatives as well. That's actually more his background, although he likes to talk about REITs and especially private off-market REITs. We'll get to that in just a bit. And last but not least, this is in no particular order, to my right, Tom Fink, CEO at Babson Capital out of North Carolina. 200 million AUM, private equity, global high yield, fixed income as well. Correct? So gentlemen, all three of you, welcome, and thank you for being part of our panel.
Thank you.
We do want to make this interactive, so we're going to do questions at the end, but I want to get you guys warmed up. I've been told that at the Mothership Conference in Beverly Hills every year in April, a lot of people who go there are first-timers. So just a show of hands, how many of you are here, obviously not for this conference because it's the first one, but here for the first time at any Millikan conference? Wow. Okay, so there's fresh blood and fresh ideas, which is what I'm told this thing is all about. Okay, so we've started that. Here's another one. How many of you are Scottish in the audience? None. Okay, that's pretty good because I mean the Scots abroad are not a happy breed, I'm told, because they weren't allowed to vote, even register. They don't have absentee balloting. But anyway, so you know what's going on in Scotland, the vote, and the results are just starting to come in. The pound is rallying. Last I checked, because 2 counties have gone for no. One of the big events, and maybe event risks for, at least for myself and what we do this week. But it's been, boy, what a week, right? We had the Fed, we've gotten through that. That's good. Got a new dot plot to go and look at and scrutinize. Scottish vote, that's gone down. Tonight, Asia time, we've got Alibaba, the mother of all IPOs. hitting the market, right? Priced at 68 top end, we'll see what it does. And for those of you who are interested, the new iPhone launches as well. So we've got a lot of competition here. But let me start with that and ask you three, just down the row, out of all of those, what is the one thing that is going to change the way you make money or the money that you make? John?
Well, I guess, stepping back, I think it's probably, look, our business is fueled by credit. 6 years ago, this week was, or last week was Lehman, the end of the world as we know it, probably the most traumatic event in all of our business careers. And so all of our recent returns that we've generated have been out of the wreckage of that time. So we've had a hell of a run, and we're in the private equity business. We borrow a lot of money, billions and billions of dollars to buy businesses, and we've been great beneficiaries of the credit boom. And we watch listen, every time the Fed makes an announcement, it makes a huge impact on us. We're borrowing money at unheard of rates and on more unheard of terms, long maturities, no covenants. We're borrowing 7-8 times cash flow at 5 times, at 5% interest rates, and that's pre-tax in America. The government pays 40% of your interest expense, so you're kind of borrowing money at 3% after tax. So that's been an amazing engine for us. We don't know how long it will continue, and our basic decision has been to borrow every nickel we can as long as it does continue at these wonderful terms the market has given us.
Well, here's the thing, right? Because we've got that new dot plot, and the way I reckon it, the Fed is probably a hike or maybe even a hike and a half ahead of what the market is actually pricing. So does that necessarily mean the party's over for you?
Well, we don't, we're not economists. We don't really know when the party is over. We thought it would have been a little more over already than it has been, and the credit rally has been more enduring than I think we certainly thought. And so without just kind of predicting when it's going to be over, we're just assuming it's going to end at some point, because everything does. Look 6 years ago, look 20 years ago, where there's, the capital. I started my career working for Mike Milken at Drexel. We lived through the 87 recession, and we lived through the 89 disaster. So Mike taught us trouble is opportunity, and markets change. Markets never stay the same. Right now in America, it's a very wonderful time. The stock market's at an all-time high. Credit is abundant. The economy's pretty good. So all that means is it's not going to keep that way. We just don't know when it's going to change.
Okay, which reminds me of a conference call we did a couple of weeks ago. You said, look, every PE you know right now is modeling exits. You are, obviously. Tom, yourself as well, or not?
Well, we're more taken from the credit standpoint. We're a big provider of credit to our partners like Leonard Green, and we invest in their funds. We do some direct investing. So maybe taking the other side and agreeing with Jonathan, there is definitely an easing of credit that's out there that has built up over the last several years. When I look at the deal flow we looked at in 2009, we could probably get comfortable in terms of underwriting 3 out of 4 deals that came across our desks. Today, that's probably closer to 1 in 4 is getting approved. So,
and what happens next year?
That it just depends where the cycle goes at the end of the day. We're long-term investors, and we believe you can invest through the cycle. There's only been certain moments in time when the entire credit market shuts down, and that is in obviously the great financial crisis, coming out in '91. So there will be ebbs and flows to the credit markets. Yeah. Right now, this year is probably a less attractive year compared to the last 3 for high yield. I think single-digit returns, not low double digits. So certainly the cycle feels long, but it doesn't feel like we're still putting money to work.
All right. So, what we've been through the last couple of years, people describe as a stretch or a reach for yield, right? And when I think about, Samir, what you do, REITs and real estate, rising rates and reach don't always go together.
Yes and no. The relationship between interest rates and real estate valuation is tenuous at best. It really depends on the trajectory and pace of interest rate changes. If interest rates increase in response to an improving economy, inflation, replacement costs going up, that is probably good for real estate. But if interest rates go up because of, say, mis-signaling as they went up last year in May, that is bad for real estate.
So here's the thing. If you take the glass half full approach or view, then it's good for real estate. What view do you take? What's your fundamental view right now on the state of the recovery in the U.S. economy and in real estate too?
I think that the U.S. is in a mid-cycle expansion phase with activity rebounding. So we have a much steadier outlook this year than what we did last year. There's less ambiguity. There's more financial stability. There's less fiscal drag. And there is cyclical momentum and a general improvement in most leading indicators. And I think you'll see that reflected in the volatility of the stock market too. The VIX has been in the 10, 15, 20 range.
Yeah.
And I think that's because a lot of tail risks that were there last year, realpolitik barriers to the debt ceiling resolution, gridlock, political impasse in Washington, Europe, all of these things have gotten kicked down the road. So for the moment,
Kicked down the road and almost sort of ignored, right? Because when you bring up the VIX, we are, I think, still well below the historical average, right? Which raises the question, the way markets have been behaving, right? A lot of people are asking the question, is risk being mispriced, John?
Well, look, the stock market in America is up over 50% in the past little over 2 years. Earnings are up dramatically less than that, although they've generally been up. And they've generally been up on increased higher margin rates rather than top-line driven. So, at some point, that trend can't continue. Well, and also the economy is reasonably okay, but it's a very differentiated economy. You talk about Alibaba. Alibaba is a signal of changing consumer buying habits in the world. So in America, you have certain segments today. Automobiles, it'll be a record year for automobiles. 17 million automobiles will be sold this year. Right now, travel and leisure in America, booming. Technology, iPhones, booming. But there's a lot of energy, booming. A lot of sectors that are much tougher. Half of our business is in the consumer space. The consumer world is 70% of the U.S. economy. And you have great companies like Walmart struggling, huffing and puffing to stay flat. Macy's, Procter & Gamble, the great consumer packaged good companies, have no pricing power. What is the value of a brand in 2014 compared to what it was 10 years ago? Just the way the millennials are spending. So our job is to find opportunities in this dramatically changing economy in America, because there's so much going on.
And I want to ask you about the consumer in the United States as well, because, you found opportunities in retail in both ends of the market, have you not? Luxury, the high-end, good margin business, as well as the discounters.
Yeah, look, our job, we've been the past several years in a low single-digit GDP growth economy, very low rates, very low inflation. We don't want to find companies that are going to grow with the GDP. Our job is to find businesses that are growing much faster than the GDP. And America, I still think, is the most entrepreneurial, exciting country in the world. There's a new idea. There's a new company every minute. Silicon Valley gets all the press, but there's a lot of other great, young, interesting companies in America. And our job is to find the growth. And to, look at our fund, 25% of our capital interest in where we're an American focused from an investment point of view. 25% of our capital comes from people like you in this room, from Asia, from Korea, from China, from Hong Kong, from Singapore, sovereign wealth funds and that type. And they're looking to invest large amounts of capital in America to find great opportunities still in America.
Yeah.
So there's lots of opportunities. We're having to find, to use a technology term, disruptors or market share stealers in such mundane businesses as food distribution or in various aspects of the healthcare industry. You can find game-changing businesses. So there's great growth companies still in America in a relatively unexciting growth environment.
Interesting. So 25% of the money that you have under management is from Asian sovereigns, is what you're saying?
Correct.
And Tom, I remember we had this conversation as well. About a fifth of your money, third-party money, is from Asian sovereigns too.
Or from Asian investors, institutional, not just sovereign.
Okay,
So Asian banks, pension funds, insurance companies. So a little more broad-based than just the sovereign.
Okay, and how are you putting their money to work right now?
Well, a lot of our third-party money is geared towards our global high-yield credit businesses, and then also on a secondary basis, our real estate business. Similar point, I think when you're putting money to work, there's a lot of headlines about where our market going, where's the value. I think the trick being fundamental investors, much like being a private equity investor, is you got to look at these companies and what is their sustainable business model. If a private equity firm is buying a company because they believe in those growth prospects, how do you get comfortable with financing in that and at what price? Clearly, I get more worried if you're looking at old business models that are just trying to leverage up on a stage 4 situation and get cash out to the owners. We much rather be working with businesses or investing in businesses that reflect some type of above trend growth.
Okay, let's talk about funding growth a little bit more. Since you brought up, we started talking about high yield. Let's go down that road. I mean, we've seen what happened, right? The market tanked, and now it's trying to come back. What happens when rates eventually, and they will, start rising in the U.S.? I mean, does high yield not do well in a rising rate environment? Are there more defaults, or what's the track record? I mean, going back to your Drexler days.
Well, the track record is there's every now and then, every few years, there's a massive dislocation. The markets freeze up, and in some cases, the market's shut, and we can't borrow any money, and in which case, probably the best value as an investor is to, in fact, buy credit when it's depressed, which we do as well, as opposed to, we usually buy equity and finance it with credit, but when credit's not there, you probably buy credit and you get equity-like returns in those markets from credit. So when is it going to come? There's such massive global liquidity. We do a lot of IPOs. Our IPOs are performing, extremely well. At some point, it will slow down. It will change. We have to make sure we've built balance sheets that will endure whatever challenges the capital markets bring, and we have companies with business models that will ride out the storm and do well and try to find businesses that are somewhat less impacted in an economic slowdown, but everyone is impacted. Okay. So the high yield market has been a really volatile, emotional, difficult market over 30 years, starting back when I worked with Mike. The bank market today is becoming a much more important part of a source of credit for us. People want floating rate debt. They don't want to take the interest rate risk. We're doing second lien loans in massive quantity in place of high yield. So I think the bank market, and it's not so much the bank, the loan market, because the biggest sources of capital are, it's not banks. You saw some of Mike's charts. So we're very comfortable with, in the old days, second liens had, amortization, covenants, they lock you up 10 ways. Today, all you have to do is pay your interest every 3 or 6 months for the life of the loan. And the lenders have no ability to talk to you. They just pay your loan and then pay them back. Now, there may be repayment risk at maturity. If we're borrowing 7 times cash flow today at 5%, and the loan matures in 8 years, what can we borrow in 8 years? When we worked with Mike, we would borrow 5 times EBITDA and pay 10 or 12% interest rates. That's how the private equity business started in America. Today, we're borrowing 6, 7, 8 times EBITDA and paying 4, 5, 6% interest rates. So it's completely inverted in the past generation. And so, that's why it seems so appealing to those of us that have lived through the birth and evolution. Because, what Mike did, what Drexel did, which is why it's so interesting for Asia, is it really brought the democratization of capital to American entrepreneurs. And when we were at Drexel, why it was so satisfying is we would meet entrepreneurs and we could raise them capital that heretofore had been completely unavailable to them. And when I hear stories about Asia, and I was just in Hong Kong and Beijing, and how really immature some of the capital markets are for younger companies, I think in the next decade it could be an amazing opportunity.
Okay, so I'm glad you brought that up, because I talked to Mike earlier this morning, and his big thing after I listened to him was, oh my God, time warp. Asia is where the U.S. was in the 80s, just before this whole junk bond thing exploded. I'm just curious, in terms of getting access to capital, because he was also talking about how in the U.S. right now, about 1/5 of all outstanding loans are from banks. Out here in Asia, it's the exact opposite. It's 70 to 80%, right?
Sure.
How do you wean your aspiring up-and-coming entrepreneurs off of that?
I don't think it's so much weaning them off it. We actually do a fair amount of direct lending at the senior, unitranche, and mezzanine level in Asia. We have offices in Sydney and Hong Kong. And we're working with Asia Pacific private equity firms in particular. And you're right, there's more banks and less guys like us, where in the U.S. it's the flip side.
Yeah.
So in that way, it is like the late 80s, where I think that market of institutional investor in the credit, high yield credit, is emerging in Asia. And because of that, you do see some more attractive relative value at times, but you have less liquidity. I have to look at the portfolios in Asia Pac and the high yield credit and assume there's going to be less liquidity than a broadly syndicated loan in our U.S. portfolio. So there are trade-offs, but I fundamentally believe if you look over time, the institutionalization of the U.S. market that's occurred over the last 30 years, the increasing institutionalization of Europe, which was very much expedited by the great financial crisis. It really gave wind to a true high yield bond market there. Whether it's crisis or technological innovation or just investors looking for more diversified access to yield, these markets will develop over time. And that's our long-term view.
So let me ask you, is Asia ready for junk bonds for high yield?
Parts are, yeah.
Which
I think
parts?
I think certainly you've been seeing that in Australia and maybe in parts, Hong Kong, places that I think have a more advanced capital market to it. But ultimately, they're all evolving, and it just takes. What you got to really look at is underlying companies. Will you finance those companies with a set of leverage? There are very advanced, large companies in Asia, and it's a matter of them now moving from the banks to more directly to institutions.
I'm just curious, do you think it'd be fair to say, John, that, when you think of Basel III now and the new requirements, banks have to keep bigger buffers, basically, right? And we know for a fact that there are a lot of banks out here, they've learned the lesson from the 97-98 financial crisis. They're doing well, right? But because of that, because they're so conservative now, your average entrepreneur, it's great for the banks, right? But not so great for the entrepreneurs when, as Thomas is saying, capital markets out here are not quite ready for prime time in some cases.
Yeah, look, to some extent, when we borrow money, for example, whether it comes from a bank's or a CLO or a prime rate fund, we don't really care, particularly since you don't have terms in the loans where you have to have a dialogue with the lenders over the course of the loan. It used to be you really wanted to know who your bank was because you're going to have to sit down and talk to them because things change and they had a lot of terms in their contract that would require you to talk to them. So that's a game changer in the borrowing community in the United States. As far as Asia, it's just decades behind where the U.S. was, which is why I think it's so exciting. And part of my trip over here is to do a little fact-finding to see if we should be investing capital over here, as well as just, we have a lot of investors who give us capital to invest in America, and now our business and our brands are becoming much more global, so we're looking at some opportunities over here where even our capital is welcomed. So look, I was in Beijing and all these great young companies, and they're going to go public in America. I was in Hong Kong visiting with a big company, might want to do a leverage recapitalization. They want to borrow the money in America because the transactions, as we know it, the capital markets just don't exist here. So I think Mike is right, and it's a great opportunity for everybody in this room that if we're sitting here in this summit in 10 years, my guess is there have been dramatic progress, but there still will be a long way to go.
Interesting. Okay, let's take a break from high yield for just a while and get on to Sameer's your thing, not such REITs, but your background is more in alternatives. The way that a lot of markets have been going up almost at the same time together, the correlation has been kind of disturbing for some people. Does that make a stronger case for alternatives, for non-correlated returns?
In the long term, alternative investments are definitely less correlated with broad financial market indices. There is huge amounts of empirical evidence to support that. But during times of crisis, such as say in 2008, 2009, when risks are driven by systemic factors, it is those times that correlations converge, and lots of people say that, hey, alternative investments haven't served us well. But over the medium to long term, alternative investments are a pretty good idea. Also, alternatives are a pretty heterogeneous class. if you're speaking about, say, private equity, which these guys do, we're talking about venture capital, special situations, mezzanine, distressed investing. If you're talking about real estate, what we do, we're talking about core, value add, opportunistic funds, non-traded REITs. Then there's this whole spectrum of hedge funds, equity, long, short, relative value, global macro. Then there are real assets. So we can see it is such a heterogeneous class, each with very different asset sub-characteristics. So I guess specificity and choice in alternative investments is extremely important.
Is it fair to say that the higher your net worth, the more you should be looking at alternatives, or the more alternatives should form as a percentage of your portfolio?
That makes a lot of sense. In fact, if you look at endowments, you look at the institutional investors, you look at the ultra high net worth segment, their allocations go up to as much as 30, 40, 50%. And the reason for that is they are able to, for example, unlock the illiquidity premia. If you are not seeking to defease very short-term asset liabilities, you can unlock that illiquidity premia. Moreover, there are many other opportunities, such as in, say, a niche credit investing that are otherwise not available in the more liquid markets or so. So there is decidedly a big case for alternative investments for the mass affluent, very certainly now, and especially so for the high net worth.
Is that true for PE as well?
In terms of
The higher your PE, the higher your net worth, you should be looking more at sinking money into what.
Well, certainly, a higher net worth person's going to have more access, number one. I think you're seeing some of the less liquid or asset classes or firms that run them try to bring those capabilities to the broader market. Private equity, large commercial real estate, in which we do as well. Structured investments have typically been of institutional products. So the question is, what net worth do you have to be to actually get access to it? So I think there's just an access component. I think increasingly, as global wealth gets better organized, either on large global wealth platforms or coming beyond the family office model, you'll see increasingly alternative asset classes as tap that money more directly. So I think it happens, the opportunity's there. It's just a really matter of access.
Okay, let's talk about timeline just very quickly and development of capital markets, because I remember, not that many years ago when a stock market opened in Vietnam, right? They had, I think, like a dozen stocks that traded once every 2 weeks or something, right? And people were saying, look, this is a place which is just not ready for prime time capital markets as we know them. So the first money in, or the initial money in, was VC as well as PE. Does that mean that in many parts of Asia here, for guys like yourselves, for PE, there is a limited window before capital markets become sophisticated and deep enough to do what they're supposed to do in terms of funding?
Look, I'm not really an expert on Asia, but it strikes me as it's not a limited window. It's the beginning of a great tidal wave. It's going to go on for decades, just like it did in America, and it will start small. But I think PE investors in America still are somewhat cautious and concerned about some of the items on the list, whether it's rule of law, title, accuracy of books and records, fundamental due diligence items that we just don't think about in the United States, that when you come over here,
take it for granted.
It's very concerning. I had some meetings, I mentioned, in Hong Kong, and you're going to look at this in China. Be careful. You don't know if the books are really this, even when they're audited, and be careful about that, and be careful about this. We've had great success in America in investing in significant minority investments with family businesses. And it's been about a third of what we've done. And that's something I think we have to be, it's a great opportunity in Asia, but very cautious, because there have been some horror stories of firms that have invested over here, and what they thought they were getting wasn't there. So there's going to be a lot of glass broken along the way. There's going to be some pain. Probably we're probably too cautious in that respect. But I think, look, while the U.S. is entrepreneurial, I think Asia is probably as entrepreneurial as America, with a just very immature capital markets system. So that will change.
Okay, all right. Let's take a break and get back to what's going to do well next year. What asset classes are going to do well next year, Samir, do you think?
I wish I knew. But things that come to mind are things like making senior secured middle market loans to corporates, because banks are not lending, corporations are doing well, defaults have gone down. That's one area. The other area is something that we do quite well, sector-specific net lease, largely because the spread between low-cost financing and we are still able to acquire properties at high cap rates. That itself is very attractive and a good entry point at this point in time. Value-added real estate, I think, is going to do well. And within hedge funds, long-short strategies, but with a long bias, I think that's a pretty good area to be in at this point in time. For our investors, and we have around 2 million retail investors who are looking for yield, something like oil and gas, something like hospitality, where hotels reprice in an improving economy, that's going to do well. Something that can be very core to portfolios, like, for example, grocery-anchored retail. I think that's something.
Grocery-anchored retail. Oh.
Everyone has to go to a grocery
sure, of
shop.
course, yeah.
So something like that is going to do well. Abilities to arbitrage misvaluation between public and private markets, that's a good strategy for this and the next year. So it's a wide gamut of things.
So you talked about this before, public and private, where REITs are concerned. You think there is a role and a place in portfolios, especially as your net worth goes up, for private REITs, is that right?
Oh, huge, huge. And the reason for that is people are looking for periodic stable cash flows. They're looking for low volatility. They're looking for low correlation. They're looking for something that has some level of asset value growth potential, something that can be actively managed.
Why would they be better than, say, a REIT you could buy on the market?
A REIT that you can buy in the market, you would be exposed to vicissitudes of capital flows, stock market behavior. It has very little often with the intrinsic value of the real estate that you own. Also, if you're investing in public markets, you're forced to put out that money to work right away. If you're a private investor, you seek most opportune entry points in the market. You're able to hold out market cycles and exit when it is once again most opportune to do so. So there are lots and lots of very good reasons why you should invest in real estate, especially, as well as real assets in a private, illiquid format.
Okay, so publicly traded REITs, I'm curious because, for the folks out in the audience who are Asians or who are based in Asia, there's REITs are extremely popular here. I think in this reach for yield, they've done extremely well over the last year or so. But in the U.S., right? Next year, as rates go up, where is the opportunity? Is it in residential, commercial, industrial? Where?
I'm not too sure about multifamily. I think that is pretty much bid up. Residential too, I'm not too sure. But areas like exactly what you said, storage, industrial, distribution, hospitality, these niches, I think, are where at least we as responsible stewards of investor capital, and we raised, as you're perhaps aware, almost $8.5 billion in equity last year. And all our clients are retail clients. The average ticket size for us is just $40,000, but we have so many of them. Wow. So that's where we are sort of placing our capital right now.
Okay, thank you. John, next year, asset class, what's going to do well for you next year, do you think?
Well, look, our asset class is fortunate in that we have the ability to look at 5 to 10 years. That's our holding period. So we don't have to really know what the stock market or what the various markets will be doing. And that's a real luxury. Right now, the call to warning in private equity in America is the price of assets. So as I talk a lot about growth and disruptive businesses, it's pretty easy, or it's easier to identify those, and the question today is what to pay for them. And that's what we're not sure. And the credit markets are allowing us to pay prices that we've never paid before. And so under the credit market, our business has had a massive tidal wave of exits. Exits have run about 2 to 1 over capital deployed in our industry in the past 18 months. So the capital markets and the Fed have made us all look a bit smarter than we probably are. So where do we invest? So the thing that's worrying us most now is prices. And will we be able to sell a business in 7 or 8 years at a same multiple that we bought it at? And we're not sure. So I think we don't really have to worry about what the markets will do next year as much. Our gut is we've been wrong. We've thought the equity markets would cool and the credit markets would cool, and they haven't. So America seems to, and I asked everybody, why is the market going up? And everyone says, well, no one has anywhere else to put their money. And to me, that's not a good enough reason. At some point, they just figure out they don't want to be in it. Mm-hmm. And when the markets do come down, they usually come down quickly and violently and painfully. Yeah. And part of our job as a money manager is to be able to capitalize on those opportunities as well. And look, we invested in Whole Foods we committed in 6 years ago this month when Lehman had happened, the world was ending. We felt at some point people would keep shopping for food, and Whole Foods was changing the way Americans shop for food. Mm. They had a miserable couple of years. Every trend was negative. We could look out 5 or 10 years, and we were right. So if we had to base our investment on the next 6 months, we would have gotten killed.
Okay. Tom, what about you? Next year, what's going to do well?
I think one of the things you take a perspective is what's well. Mm. And that really depends on the investor. What are they looking for? And what are they looking really for? What's going to do well?
Okay, tell you what, let's drill down that because over and above you, there's MassMutual, right? For insurance money, what are they looking for?
Duration, long-term return.
All right.
And that's a good example. If you're dealing with a large institution that has a longer duration profile, certainly year to year is important. But what's really important is what are going to be your total losses in, say, a credit portfolio over the cycle? That's the key. Mm. And a lot of our portfolios, when the crisis hit, especially our credit portfolios and even our CML portfolio, where it showed, the value showed was our losses were well below the market defaults at the time. Mm-hmm. So sometimes in markets, credit markets, you're just saying, if you're just looking at the year-to-year return, well, you might have some that reach for that yield or that more loose credit standard, but ultimately when the event occurs and it's more I would say an economic downturn or a geopolitical event that causes a liquidity issue, if you're standing on a weaker portfolio, you're more exposed. Mm. So when I look at what we're trying to do is we try to work with good sponsors like Land Green. We try to invest in companies that we think are sustainable in terms of their business model. And that's a challenge with the disruptive technological world we're living with. And we try to stay diversified across industries, within portfolios. And that's part of the reason why we believe, for long-term investors to be able to move from U.S. credit to European credit, ultimately to Asia-Pac credit, developed to emerging markets, if you're able to do that and be diversified, it's less about what's next year going to do, because we really don't know. But am I comfortable with my portfolio if the worst case happens?
Okay, are you?
Yes.
Okay, and John?
I think so. It's never fun when the downturn comes, and you have to turn downturn into opportunity. But we do get concerned that these things just seem so good now.
Yeah. So here's the thing. You're looking ahead, and you've realized that look, you're probably not going to make as much money as you had initially thought. So you pivot and you do what?
Well, I think there's two things. One is what do you do with the capital markets, and I think part of what our industry does so well is we've been taught to continually take advantage of the capital markets. So in our business right now, what you can really do, you can invest your capital. Within a year or two, you can often extract your capital through a somewhat re-leveraging dividend recapitalization. So your risk is out of a transaction. And then you're much more likely to hold a business 5 or 10 years if you've taken your money out. So that's how you pivot and you react and you help. The other thing is, businesses are changing. We live in a very, very dynamic time. We have a heavy consumer-facing businesses. We own a lot of brick-and-mortar retailing. We're spending hundreds and hundreds of millions of dollars on e-commerce initiatives, on omni-channel, on social media interaction with our customers, things you didn't even think of before. Oh. And it's very exciting. It's very dynamic. It's very traumatic. the world is changing, and you have to turn that change into an opportunity, and you have to be a kind of an internet predator and not an internet victim. And easier to say than to do, but that's what we're trying to do in a lot of our businesses, because some of them, the world they live in has changed even since we've made our investment, and we're having to pivot. And it's not always easy, but you have to.
All right. Okay, folks, we've got about almost exactly 10 minutes left. So I promised you at the start that we'd carve out 10 at the back to take questions, and now's a good time. So just put up your hands. Just tell us who you are, where you're from, or what company you represent, and also who your question or comment is for. That would help us. Anybody from the floor? I can't believe this. Come on. Really? Okay, we're kind of shy. This is unusual. I've been told that, Milken conferences are not usually like this. I'm not sure what's going on here. Okay, Samir, let's spend a little bit more time with you and alternatives. Next year, what is going to make you money? I guess you got to talk about not just obviously the manager, but also the strategy.
I think the biggest opportunity is in creating proxies for fixed income, because investing passively in traditional fixed income now exposes investors to low expected returns. It has little scope for capital appreciation. There's very little scope for unlocking an illiquidity premia. There are lots and lots of very interesting credit niches that you pass on. So something like, just because you call something fixed income, it doesn't really mean it is fixed. So I think the biggest opportunity for us is to redefine fixed income in terms of what fixed income was supposed to be: durable income, something that has its edifice, its foundation in multiple drivers of return, not just interest rates, but certainly interest rates too, but credit spreads, illiquidity premia, alternative risk premia. And the idea being, the more the drivers of return, the more the resiliency of that investing thesis, and the lesser the dependence on one particular market factor, such as interest rates. So things like real assets are a great place to be in at this point
Bricks and
in
mortar
time.
is what you're saying.
Bricks and mortgage, but things like infrastructure, oil and gas, real estate, perhaps even timber, agriculture. These are pretty good areas now to be in.
I think that's a good point. We actually have a subsidiary, Wood Creek, that focuses on that niche. Where you have our commercial real estate arm, but we also, Wood Creek focuses on assets that generate a long tail cash flow. It could be anything from trailer containers to cell towers to, you mentioned the ag theme, and when you say ag, that's like healthcare. It could be infrastructure, it could be crops, it could be timber, things like that. There's a lot of assets that, quite frankly, the money that goes into those segments is not as fluid or as public or as organized. And buying that cash flow, if you will, is a place where you can get a different type of fixed income return, if you will, over the long term. So sometimes it's just looking at things a little differently, much like Samir said. There's a lot, fixed income isn't just treasuries.
Got it. John?
Well, in our world, part of what's so vibrant is, I think, we have tremendous flexibility on what we can do in private equity, and you have to be creative and you have to adapt. So a big source of transactions for our industry for many years, including us, was taking public companies private, privatizations. That really fueled the business in through just before the financial crisis and even just after the financial crisis. And now going privates have virtually disappeared in the United States because the stock market's up 50%. You have to pay a 20 or 25% premium over that to buy a business. Earnings are not up nearly that much. So even with really cheap credit, it's tough to make the numbers work. So what are we going to do with all our capital? Because money is gushing into our sector. Our limited partners are eager to put more money to work than ever. They usually based on an asset allocation. Right now, they're under their allocations in their pension funds or sovereign wealth funds, and they're receiving more inflows than outflows, and the denominator is going up because of the stock market. So we're having to come up with different creative ways to put their money to work. And the good news is we can be very creative. We can deploy our capital in ways that public equity investors cannot, or many investors. So we can come up with very structured ways to help family businesses grow. We did a transaction recently where we bought a very large block of a public company where a large holder had to sell. We bought it at a discount in a special purpose vehicle on margin, where we can turbocharge. Another interesting opportunity for our industry is to buy assets from other private equity funds, which has generally been a bad word. People frowned upon it. You guys in PE are so smart. You squeeze all the juice out of the lemon. Why would you ever buy from one of your competitors? And the reality is we are money managers. Our business is to take your money, turn it into take $1, turn it into $2 or $3, and then give you back that money. But we have to give it back. We have to sell. Berkshire Hathaway never sells, right? They're the biggest private equity firm in the world. They just don't sell. GE buys everything. They keep the good stuff, and they get rid of the bad stuff. We have to sell everything. Usually the easiest stuff to sell is your best stuff. And after 5 or 6 years, you've had a good return. You have to raise a new fund. You had a couple bad deals. So we can have very fertile territory today in selectively identifying companies that have already been owned by a private equity firm. Because I think the reality is many private equity firms sell their best companies too soon. That's a real truism. And our job is to find those and buy them so we can still deliver extraordinary returns for our investors. When you common sense would think that's a dumb thing to do. Why would you ever do that? And so we have to really bob and weave and find stuff. Energy's been, we don't really play in it, but the private equity firm has filled a vacuum in the energy sector where traditional public equity has not really been there. So we have to always change. We have to be evolving. And our simple job is to beat our investors pay us higher fees for less liquidity and try to beat the markets by 300 to 500 basis points. That was kind of easy to do for 10 or 12 years because the equity markets went nowhere. From 2000 to 2011 or 12, your bogey was 0. So you looked really smart. Now the market's up 50%. We don't look quite as smart, but we don't think that will be sustainable. And we'll go back to something more normalized. And if we can deliver you 500 basis points over, then we've earned the fees that you've elected to pay us.
Real quick last question. This is sort of an Asia-related question. A lot of your businesses and your brands are consumer-facing, right? We know that. You were telling me how this is sort of a scouting trip for you out here in Asia. We were just talking about the Alibaba IPO, right? E-commerce, et cetera. So obviously there is a demographic dividend to be extracted from out here in Asia, with the exception of a place like, and this is curious because largest e-commerce market in the world, China now, demographics are against them. One, right? Consumption, they haven't rebalanced yet. So as a PE guy, how do you look at this?
I don't think we have the answers yet. We continue to be amazed, having just spent time in, say, Hong Kong and Beijing, at the incredible, unquenchable thirst in China and Asia for American brands and American products. And whether it's a Whole Foods or a hamburger chain, we have Shake Shack or Topshop or J. Crew. There's this amazing infatuation with American brands. I think huge opportunity for us to bring our brands to Asia, to China. Now, how do we do it? Do we do it with a partner over there? How do we mitigate our risk and make sure we're in with the right people? One of the things that strikes me as I travel around Asia is involvement of the government is just so much more dramatic here in business, where we don't even think about it at home in America. And here, what's the government going to do? Who do you know in the government? How is it going to do this? So that's a big kind of red flag for us.
Okay, and that what you're talking about is policy risk, right?
Yeah, and could you sign something and then they change the rules on you? Sorry, just kidding. We don't care what that says. But we look, and then you sit down in these meetings and they tell you how many cities have over 5 million people and the unstoppable wave of the growth of the middle class, even if there's fits and starts along the way. So, that's massive opportunity there, and how we play that is what we have to figure out. Okay. But I think it's a huge opportunity, and a lot of firms are here way before us. There's a lot of the big mega funds have been here. There's a huge venture capital community already in China. So I think we're going to pick our shots carefully and hopefully do okay when we get the courage to do it.
Okay, all right, to wrap up then, for John, it's policy risk on the government side. Samir, the biggest risk for you next year is going to be what?
It's going to be our ability to look 3 to 5 years into the future, to live in 2017, 2018. And this can be a skew of factors. But given the higher contracting costs, the longer term nature of our assets, et cetera, it's going to be our ability to not miss the forest for the trees.
Yeah, because you guys have much longer cycles, right?
Exactly.
Yeah, okay. Yeah.
I think the biggest risk for us next year will really be a matter of if everybody gets too focused on the interest rate story, that keeps flows going away, maybe from credit, as we've seen more lately, which could, from a business perspective, have an impact. It might be good from a market perspective to take a little steam out of the markets. I don't think we're near a credit precipice because I think corporates in the U.S. and in the other markets we invest in are in fairly good shape in terms of being liquid. But there will be reactions if rates do spike more than anticipated. That could affect markets.
All right. Excellent, gentlemen, all three of you. Thank you so much for spending time with us, and thank you for being part of this panel. We've got maybe 30 seconds left for one question if anybody wants. Really? No? I can't believe this. Okay, we'll try again next year. Thank you so much.